Hi guys, in this knowledge snippet, we will be discussing about a very commonplace term used in our daily lives, that is inflation. In simple terms, inflation is rise in price of goods and how it affects our pockets. For detailed analysis and to save quick bucks, do watch the full video and please like, share and subscribe to my channel Formulating Finance. Have you ever wondered that how rising prices of goods and services affect our savings and investments? To be honest, you need not be informed about the economics principle to decode that. And in this video, we would be giving you several examples to verify them. Before that, let me just take you through our latest inflation numbers which are released by Reserve Bank of India in the form of Consumer Price Index. Consumer Price Index simply tracks the prices of food, beverages, clothing, etc. Hence, it gave us an idea about price increase at our. If we go by the numbers, in June 2020, the inflation rate was 6.09%, which means if you could buy something for rupees 100 in the last year, this year it would cost 106 rupees. So, that being said, which is more important is to look at the bigger picture, that is, compare your investments with inflation. And that's what we are going to cover in this video. For better understanding, do watch the full video. We all are impacted by inflation, but how? The impact of inflation has on our money is that it decreases the value of 1 rupee over time. Suppose last year you could buy 2 toffees with rupee 1, but this year you can buy 1 toffee with rupee 1. Though I have the same amount of money, that is rupees 1, but the ability to buy the same amount of good has decreased. Why is it important for any person? Corporates have announced no wage hike. The salary remains the same for the next year, but prices are increasing. You are at loss. Liquidity issues with the investment. The prices have fallen and you don't want to sell in this market. So, what to do? Pandemic has surely made us realize the value of inflation and how it is eating up our wealth. Now, let's discuss about the whole inflation thing is a villain for you. Suppose 1 year back you had 100 rupees, you could buy 100 units, considering inflation of 4%. Now, the same goods are priced at rupees 104. Now, you cannot buy those 100 units. You have to buy less than 100 units, that is 96 units. A loss of 4 units is cost to you. Now, let's imagine the same situation and considering you have rupees 100 and you invest that rupees 100 in a saving bank account giving you 4% rate of interest. After 1 year, you have rupees 104 and the inflation was also 4%, making the price of good as rupees 104. Now you can buy same amount of goods, that is 100 units. Now let's imagine instead of investing in saving bank account, you invested in stock market and you earned a return of 10%, which at after 1 year you have rupees 110 and inflation stays at 4% and the price of good is now 104. With this calculation, you can buy more number of goods, that is more than 100 units, as you have more amount of money with you. You are able to get higher returns, but at additional risk as you have invested in stock market. Some important things to consider while making an investment are: first, inflation in the economy. But from where to get this information? The easiest source is pick up RBI data for Consumer Price Index. Second is excess over inflation. We should compare the returns in comparison to inflation. How to do it? Follow a very simple equation. Nominal returns is equal to real returns plus inflation. Suppose an investment is giving you 10% interest. So, and an inflation is 6%. Your real return is just 4%. Third is to look for investment horizon. When you invest your money, it helps you to accumulate money over time. But as number of years increases, the effect of inflation also increases, which can be harmful for your money. Fourth is return and risk perspective. Currently, saving bank account interest is as low as 2.75% and for FDs it is just 4.5%. If we compare it with inflation, the they are giving you negative rates. That is, for saving it is minus 3.25% and for FDs it is minus 1.5%. Suppose instead of them you invested in equities, which gives you 15% interest. When we compare it with inflation, you are getting at least 9% real return, but at higher risk. Keep in mind these 4 parameters: inflation, excess over inflation, investment horizon, risk and return perspective. And from next time, whenever you are excited to see an investment scheme, to think in net off terms after adjusting for inflation. Thank you for watching the video. Please like, share and subscribe to my channel Formulating Finance, and don't forget to press the bell icon for instant notifications. Thank you all.